Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, September 9th, 2016. So Friday we had a sharp drop in stocks caused by a variety of reasons. You can pick your own: North Korean nuclear test, ECB in action, or Fed comments. But it was overall a good excuse to sell stocks, basically. Not surprisingly, interest rate sensitive groups fell hardest, such as utilities and real estate, etc. We'll look at bonds in more detail, and they look like they're headed, there may be more downside to bonds. Dollar loses ground against other currency, but only slightly. As a result, gold is really not out of the danger zone just yet. Oil may be headed for retested resistance just above at $50, and XLE, the energy ETF, is at resistance again. And we'll finish off with natural gas. Okay, so first of all, I wanted to say that there is a couple of reports that are coming up next week, which is Thursday, September 15th. There's a retail sales report, and then next Friday there is a consumer price index, or CPI, report that you should be aware of. So first of all, we'll start with stocks. First of all, the ECB, European Central Bank, on Thursday did not extend the stimulus, so they left it as it is, and this caused pretty much selling, really strong selling in the Eurobond market. So this is a Thursday's candlestick, and it's just enormous. You can see compared to other candlesticks. Now, Friday we had follow through to the selling, and what is concerning if you're a bond investor is this volume. It's not that high. In other words, this is not yet a climactic sell-off. Like, for example, here we had a large volume. If I go back, we had another large volume sticking out. So this was like a climactic sell-off, for example. But here it's not, doesn't feel like it's done correcting just yet. So we probably will see more selling in bonds. Now, also we had a nuclear test on Friday by the Korean people. And another thing is there was a concern about, Federal Reserve member support of hiking rates in the United States. So all of this combined to cause selling in the United States stock markets. So for example, here S&P 500, you can see that we gapped down from the morning and then continued selling. And in fact, we finished near the close of the day. This one looks like a large volume, and the reason for that is because we took out stops. So the stops were hidden here and here, and that makes perfect sense for them to be taken out. So, support, where is the support? Here is a good support right there, and then of course lower down around the Brexit lows as well. Now, generally speaking, I think this is still a bullish chart, and I will be looking to re-enter on the long side. My proprietary index, market breadth index, which attempts to call a long-term bullish or bearish picture, is still firmly in the bullish territory. So, like I said, I think this correction, which is long overdue, because of this very large move from this low to this high, is about almost 11%. So this correction is way overdue, and it's normal to have a correction. Now, how sharp of a correction and how deep of a correction we're going to get is pretty much anybody's guess. Here is S&P 500 in the weekly time frame. Actually, just last week I mentioned this breakout, so we are already testing this breakout. And again, we will see where this correction will take the index. For comparison's sake, I wanted to show that this is a list of all of major sector ETFs. So this is a weekly time frame, and you can see that we had a very large losses for the interest rate sensitive ETFs such as real estate, utilities, and telecoms. So they are more interest rate sensitive, while the financials actually lost relatively little for the week, because they stand to gain the most from the interest rates going up versus the other sectors. Here's another one that really got hit pretty hard. This is home builders, interest rate sensitive group as well, a very large candlestick, and also on very large volume. So this already kind of feels a bit overextended to the downside, so it's possible that this is as far as a correction as it will get. Here's a weekly real estate, and I put in this support resistance. It's pretty much already at support. Here is XLU, same thing. These are all-time highs, so this is very much still a bullish chart. So in a pullback is normal, and this is a correction within a bigger uptrend. So we can see a bigger support around 47.25 or so. And here is a telecommunications ETF, IYZ. Same thing. This is a breakout above resistance to all-time highs. So we are, maybe a little bit more, and we're going to be already at support, which now turns at resistance, which now turns support. So, generally speaking, again, I think that stocks are bullish, so I will be looking for buying opportunities within this bigger uptrend. All right, so just to reiterate, the euro bond has dropped really significantly, a very large filled candlestick on Thursday, followed by another red candlestick on Friday. Now, we are sort of at support here for bond, but like I said before, I think the volume is still relatively low, and I think we may see more selling in the bond universe. In the United States, the TLT, the Treasury ETF, really followed bond pretty much similarly, but not as sharp. For example, this is the Thursday's candlestick, and you could say that this was a breakdown of this triangle consolidation, but you can also say that the support was down here, right here at 136.49. So Thursday, maybe it wasn't yet broken, but certainly it was broken on Friday. And like I kept saying, we had very sharp advance, a vertical advance. We had multiple gaps here on TLT. We have this gap, we have this gap. This gap is now closed. So now there's another gap here, but I think the bigger issue is this gap down below here. So I think there is still some correcting that needs to be done for the bond market. Now, long term, it's possible, but not a guarantee, that we have seen the top in the bond universe, in the bond market. Predicting a top in a very bullish security is really notoriously difficult, and we had a bull market in bonds for many years. We could go back, say, 30 years and see what the United States bonds were like back then, and you can see that it is just pretty much non-stop advance from the 80s until now. And notice that there were multiple peaks, intermediate peaks, that ultimately did not work out. So is this one going to be different? And the answer to that is, I have no idea. As of right now, I think TLT is still bullish because these are all-time highs, and we have basically an uptrend. So possibly we're just going to get a correction and then a resumption of an uptrend. As far as a more diversified bonds, this is a aggregate bond fund, AGG. Similar picture. It's just not as violent as TLT. We had a gap here on Friday, but you can say that this support is even, still down below here. And there are lots of gaps here as well. There's a gap down here. This gap is still technically not even closed. There's another gap down below here. So all of these gaps eventually need to be closed. I don't know exactly when they will be closed, but most likely they will be closed. As far as the AGG, the volume was not that high, so it's possible that we're going to see more correcting. And alternative scenarios, we just turn around and make all-time highs yet again. So here is the same fund on the weekly time frame. So I pointed out this pattern here, the depth of this pattern, which kind of looked like a consolidation, possibly a triangle consolidation, broke out, completed the target move 3.4%, and then some, and then we kind of consolidated in this flag pennant fashion for the past couple of months. But this Friday and this week, this is a weekly chart by the way, this Friday and this week we definitely broke this particular pattern's trend line. So maybe we continue lower, or possibly we'll just redraw this pattern. So for example, right now it is a pennant, but maybe it will become a flag. It's also possible. So to summarize, I think bonds are still near all-time highs. They're bullish until proven otherwise, but this reversal, it is possible that this is indeed a reversal candlestick. And then basically in a few days to weeks ahead, we will see where this is going to. Moving on to the Forex universe, this is US dollar on a daily time frame. It's a really messy chart, you can see this. For now, the way I'm reading it is we have resistance up here in the 96.5 and we have support here around 94. There is even stronger support down below, and we can see it from the weekly charts. But for now, we're just kind of moving sideways in this range here. Now, maybe this is all there was to the down move, and maybe we'll just resume an uptrend. And next chart I'll show that if we break out above this level at around 100, we could see a significant move in the dollar to the upside. So here's that weekly time frame. And you can see that this is a consolidation, breakout, and another consolidation. This is a weekly this is a really long term. This is about 3 years. So the past couple of years we basically have been kind of consolidating in a sideways manner, but there is definite range to this consolidation, and the range to the upside is around 100. So if we hold support here and continue higher and break out above 100, we could see significant upside. Namely, we could see about this entire move duplicated on the upside. So depending on where you measure from, but we can be conservative, and let's say we measure from breakout to breakout, that's around 8%. But we can also be very aggressive and measure from bottom to top, so that's about 22%. So it just depends on where you measure this potential breakout from. An alternative scenario, which is also entirely possible, is that we don't hold support and we actually turn around and continue lower. But for that to happen, the euro must really be moving up strongly. So let's look at euro. So this is euro on a weekly time frame. I showed this chart in the past. It's almost like a mirror image of the US dollar. You can see a breakout, but here for euro you can see a breakdown. So for now, if the euro seems to be wanting to push slightly higher and maybe retest this area here and 1.171 to maybe 1.145 or so. If the resistance here is reaffirmed, we could see a turnaround and we can continue lower, and actually a breakdown below 1.04 could mean significant more downside for the euro. As far as GBP, British pound, you know, we're basically, I think we're bottoming out here in this area here. This is still a bearish chart, so I probably wouldn't be necessarily be extremely bullish on this chart, but it's possible we get to maybe 1.38 before the shorts come in again. And then finally, the US dollar versus the Japanese yen. This one is, I keep saying, is quite interesting because maybe we're seeing finally a reversal, because looks like this area here of about 100, 174 seems to be of great importance to the Japanese yen, and we have multiple touches of this area here, and it's possible that it will bottom out here, and by extension the US dollar will appreciate versus the yen. So to summarize, it's possible that the dollar has pretty much, that was the move down, and then we're going to turn around and move higher. This will have repercussions, especially for gold, which we'll look at next. All right, this is gold on the weekly time frame going back to 1977 with the US dollar graphed in green. And I kept showing this chart. This is showing that, generally speaking, gold and US dollar are inversely related. In other words, if gold is going up, dollar is going down. Now, of late, there has, and you can see that there are forays into positive correlation. In other words, sometimes both gold and dollar are moving up together, and sometimes both gold and dollar are moving down together. So it appears to be one of those time periods right now when gold and US dollar are somewhat positively correlated. In other words, both gold and dollar have been moving up, well, in the past few months. But I think, eventually they kind of diverge again, and gold and dollar go their own negative, they become inversely correlated again. So if I'm correct and the dollar is going to appreciate, then gold will come under pressure. This is daily time frame for gold, continuous contract. So the dollar has dropped last week, and we saw a really strong spike for gold in just, let me see, 1, 2, 3, 4 days or so. And actually, my subscribers and I, we opened the position, and we were able to capitalize on this even short move. So we're sitting in a profitable position right now. Where is this going? Again, as I said, if dollar appreciates, gold will come under pressure, and it's possible that we're seeing some sort of a top-in action here, at least in a daily time frame. If we look in the weekly time frame, the picture is better, and you can kind of see this. Well, there was first breakout right there, breakout here, then consolidation, a retest of this breakout on actually several occasions, and then another breakout right there. And now we had 1, 2, 3 retests of this breakout at 1300. So for now it's holding, but I don't know if it will continue holding in the future. And as I said before, I think it all depends on the dollar. Here's, for illustrative purposes, this is gold on the weekly time frame going back 5 years, and this is one of my proprietary gold breadth indexes, gold breadth index, which attempts to show whether or not we are in a bull or a bear market. For now, I think we're in a bull market for gold, and as of right now, I think we may still there's a higher probability of gold appreciating than it rolling back over. Here is GDX. This one, just skyrocketed off the all-time low. They're actually back here, all-time lows to 52-week highs, almost tripled, and now is correcting, or maybe it is done correcting. I don't know. It will really depend on the dollar. But for now, we opened the position, and we were profitable on our position in GDX. Again, not sure where this is going, but it's possible that this level will not hold also. So in that case, gold may roll over below 1300. An alternative scenario is we consolidate sideways and maybe break out above this 1377 level. And the same thing for GDX on a longer term time frame. My GBI, the gold breadth index, can also be used to trade it. So it was in a bear market. GDX was in a bear market from 2012 or so, and now I think we're in a bull market. All right, moving on to the harder commodities. This is West Texas Intermediate light crude oil and a weekly time frame. I still think this is a bearish chart. Weekly time frame still bearish. I think there is resistance here. It's still around $50, 53 maybe or so dollars. So maybe in the next couple of weeks we see another retest of this level. I mean, for now, I was actually kind of surprised that we rolled over here and we had a strong down move here. I think a bigger resistance is up here in 53, around here, where we had multiple peaks here, and also these peaks here. So about $53, $54, I think, is a bigger resistance. And if we come up here and fail, this could be extremely bearish. For example, we could come up here and then roll over with a vengeance and maybe break even below this level, which also becomes important now because of the multiple touches of that area of around $40. By extension, the XLE, which is an energy ETF sector, also is still in the resistance area here. I mean, it was one of the sectors that did not drop for the week, but again, as I said before, if oil rolls over, I think XLE will follow, really. And here is natural gas, continuous contract on the daily time frame. I think this is a bullish chart. I think these are all 52-week highs, so we're very close to 52-week highs, and we could easily break out to fresh 52-week highs for natural gas. This chart, I think, is bullish. The bigger reason why I think this is a bullish chart is because of the weekly time frame. This is a breakout here, breakout 52-week highs, a couple of retests here, 1, 2, 3 weeks at retest, and then another push higher. So if we hold here, and we can just easily break out to 52-week highs again. All right, that's it for this week's recap. If you have any questions, please don't hesitate to send them in, and please stay tuned on how to find us on the internet. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now, so please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the successes in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members, so that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right, thanks for watching, and please consider signing up for the trade alert services. Bye-bye.